The time to buy is now. That's what we're going to cover in this monthly market report. This is for you if you are a real estate agent, a financial advisor, or an attorney interested in market data to help you advise a client, or perhaps you are that potential buyer or seller looking for some direction. I'm Paulo Rodriguez. I've been a mortgage professional since 2005, and here is the market data that you need to make an informed buying or selling decision, or help your client do the same. We are very much in a demand-based rate environment, and what I mean by that is better explained with this graphic. This is the average conventional 30-year fixed rate going back to January, and what we know about buyer behavior is that there is a clear dividing line between red and green, which is the 6.5% threshold. With rates having dipped over the last month, it feels like, at least to me, that buyer demand has more than doubled. And considering that mortgage rates are likely to continue their descent over the rest of the year, I don't see demand from buyers tapering off. So how do we communicate this with clients we're working with? How should this impact their decision making? Well, as rates come down, it makes homes more affordable. Yet one of the things that people think is that the only way homes will become more affordable this year is if prices come down, which is not true because there are three factors that affect affordability: price, rate, and wages. More to come on that, but let's break down prices first in order to understand what's going on with them. To give us some perspective, let's go back to some headlines from the second half of last year. Headlines like, US housing prices could plunge 20%, Dallas Fed warns. The Dallas Fed really stirred up a lot of people with that article. A couple of months prior to that, Fortune came out and quoted Moody's saying there are 210 US housing markets at risk of losing 15 to 20% in value. And there were many other articles talking about homes could lose a massive amount of value. I said it back then, and I'll say it again. Nothing could be further from the truth. Here is the Case-Shiller year-over-year home price appreciation in the top 20 cities. Now, let me make something clear. This is a year-over-year comparison, meaning we are comparing January 2022 to January 2023, with the national number being 3.8%. So why is that important? Well, it's nowhere near what all those headlines said in the fall. They said 20% depreciation. Sure, there are some markets that have seen depreciation, a few West Coast markets that are heavy tech markets, but it's not happening in the entire country. CoreLogic said this: declines in the West are due to the tech industry slowdown and a severe lack of affordability after decades of undersupply. So understanding this and being able to explain that to a client is critically important. And if we continue this look at year-over-year price comparisons, this time from the Federal Housing Finance Agency, we see the same story. The Pacific region being flat, every other region appreciating, the national rate of year-over-year appreciation being 5.3%. So those were year-over-year comparisons. Once again, that means comparing a given month this year with the same month last year. Now, if we start to look at month-over-month pricing, the situation is a little bit different. Month-over-month means the comparison of two consecutive months, such as January and February of the same year, for example. And if we look at the Case-Shiller month-over-month change in January, what you see is slight month-over-month depreciation, not this runaway scenario of depreciation like those headlines mentioned. For the most part, prices were flat on a month-over-month basis. If we look at the same with the FHFA, we see a similar story. Some regions being slightly down, some regions being slightly up, some regions being flat. Now here is the month-over-month look over the last year from the FHFA and Case-Shiller going back to January of last year. And so what can we see? What's the story here? Well, the headlines that I showed you earlier, ironically, were from the same time period that the depreciation peaked. As I said in the past, you can always trust the news to put you on the wrong side of a trade. Most of the depreciation peaked in the fall, and there hasn't been a substantial drop since then. And so what this amounts to is that, according to Black Knight, home prices nationally are now down only 2.6% from the 2022 peak. Down 2.6%, not down 20%, not anywhere close to it. Moody's said this: Moody's Analytics repeat sales home price index is down 2% from its peak last July. So again, nowhere near 20%. And Freddie Mac reported that its national home price index is down 2.5% from its June 2022 peak. Again, nowhere near what some of those headlines said would happen. And I think the case could be made that the worst is behind us. So let's go back to the topic of affordability. I mentioned earlier that this is comprised of prices, rates, and wages. We already established that prices are relatively flat. Wages I won't get too much into, but they have a tendency to go up slowly over time. And so what that implies is that mortgage rates are truly the key factor that are driving today's affordability. Here is a quote from Realtor.com. Each downward tick in mortgage rates is met with increased buyer demand as many eager home shoppers take advantage of the slightly lower cost of financing a home. And when we talk about affordability, we also want to talk about monthly mortgage payments. Here is a look at that, also from the National Association of Realtors. And as you can see, paying a mortgage was much easier to do in January of 2021 when it was much more affordable to buy a home. We saw that creep up very significantly as of last year, and the median monthly mortgage payment peaked around October when we saw the highest mortgage rates during this time period. So now that we're seeing mortgage rates easing, that's about a $200 per month difference since last October for the median price home. And so when every percentage point counts in a mortgage rate, every dollar counts in a mortgage payment, this is really important news, really important information to be able to share with our clients so that they can see how things are changing. Most important of all is the reason why I'm sharing all of these stats with you in the first place. There are many clients that think the best thing to do is wait to buy, wait for lower prices and/or wait for lower rates. And if you watched my report last month, this is going to sound familiar. If you're waiting for lower prices and/or rates, what do you think everybody else is doing? You're probably not going to get lower prices. You will definitely get the lower rate, but you will also be in a much more competitive environment, which will force you into a bidding war. The time to buy is now. That's a wrap for the April monthly market report. I appreciate you listening in. Forward, subscribe, share. I'll be back next month. But before you go, if you're looking to purchase or refinance or know someone that is and would like a no-cost consultation with me personally, feel free to reach out and I'll be happy to analyze if your debt is structured in the most optimal way or if there's room for improvement. Thanks for watching. Bye for now.